Hello, mortgage fans. So welcome to our weekly update. This week, we're going to talk through a little bit about the upsides of inflation and why the inflation decreases cost in real terms, one of my favorite economics terms. But before we get into that, if you've seen the news cycle so far into 2022, it's been pretty crazy. We've got Boris Johnson having an inquiry as to where he was, which takes some thinking about. Prince Andrew is no longer Prince Andrew for reasons which I'm absolutely not going to get into. But if you've got WhatsApp like I have, we pretty much know why. And then you've got Djokovic's ongoing visa saga, which is a bit of a shambles, really. I thought the UK was turning into a backward little island until Australia weighed in with their visa policy. So that's just what the first few weeks got in store. Looks like it's going to be a lively year. But more specifically in the mortgage world. So like I said, what we want to do is talk about inflation and debt. It's one of these sort of symbiotic relationships in economics terms. So the thing that sort of triggered this thought is that GDP is now above pre-pandemic levels. I'm just going to talk about that in a bit more detail. What that means in context of very high inflation we have in the UK right now, and then ultimately where that will take us with interest rates. So to start off with those GDP figures, so the most recent available figures are for November last year, which showed GDP was up by 0.9%, which is now 0.7 above when COVID started. One thing I just picked out was interesting that construction was the main growth area at 3.5%. Which is really relevant when you're in the sort of property and mortgage world. So if developers do start building property more meaningfully, that hopefully might mean that property prices won't go too sky high. But funnily enough, that's a specific example I've picked on later if you want to know what happens to that over time. Also, another thing that's really interesting, which I might talk about in another update soon, but one thing that caught my eye this week as well, I believe it was Michael Gove was on Radio 4 when I was listening to it, is that the government are specifically targeting developers to resolve the issues around cladding. Not very clear exactly how they're going to do that, but they've given them 2 months to sort of do that. So it's not actually on the owner of the property, more it's the developer. So if you're in that area, probably more to follow on that. But getting back to the GDP part, so there was a really interesting quote I picked out from a guy called Richard Dunne who runs YOU Asset Management, and I'll just read that out actually because it was quite interesting. He says that economists are predicting that UK economic growth could outstrip every other G7 nation this year, and today's data is timely reminder that investors should prepare to make the most of it. With sky-high inflation and supply chain disruption still on the agenda, a resilient portfolio prepares you for the challenges is still the best solution. So a bit of a pitch there at the end, but that is really the point I'm trying to drum to here, is the economic growth that we're going to experience and also high inflation makes it a very interesting place. Now, also a little caveat to put on those figures, that is pre-Omicron figures as well. So let's see how that plays out. So more specifically, when you have inflation and debt and what that means together. So again, I've just pulled out some figures just to contextualize this. So as of October 21 was the latest figures I could find for UK national debt was 2.2 trillion pounds, and that would have gone up since 103% of GDP. Now, always the way I tend to think about this, so you can sort of get your head around that, is that if, say, for example, you had 1 times your income on unsecured debt on things like loans, credit cards, etc., you'd know how painful that feels. So if you, that's sort of where the UK is right now. Now, I appreciate the dynamics are very different. It's long-term debt and etc., etc. But once you get around to that sort of area, it's extremely uncomfortable. And we're one of very few countries in the world, certainly any Western country, that has debt that high versus GDP. So that means a number of things. But just to sort of break it down, so that's sort of the national figure, and that means, well, ultimately we can't raise interest rates too high, which we'll go through in a bit more detail. But some other figures on a sort of more personal level, that the average UK credit card debt in the UK was £2,033, and that's at an average rate of 21%. So as I was saying, you really feel the pinch if you're on there. And also mortgage debt's going up as well. Again, for the end of Q3 21, mortgage debt was at an all-time high of 1.6 trillion, which is up 4.9% on the year previous. Interesting as well, I just sort of picked out the average UK salary is 31,258. So put those things together, quite a squeeze on personal and national finances. So you could sort of say, well, how on earth is that a good thing? Well, it's not. It's really, really bad. There's another topic I'd love to play with another day, but I think a large level of debt is akin to modern slavery, because if you get up, even if you've got a very high salary and you're trying to pay off debts or trying to sort of service everything you've got going on, that is akin to modern slavery, I think, but not in a sort of legislative sense, more in a sort of theoretical sense. But where that is a good thing is when GDP is on the up. So what you'll find is as economic growth and GDP is gross domestic product, that is when you add up everything that's sold, produced in the UK, that's what that figure is. As that does increase, as long as that increases higher than inflation or higher than the debt, it does push that down in real terms. I think GDP was up, as I mentioned, sort of 0.9 just last month. Wage inflation is up 4.9%. And inflation, as measured by CPI, is up by 5.1% last year. So what this is doing is pushing down what that debt is in real terms. And so what I've done, just to sort of, again, contextualize what that means and put it in sort of the property arena, is that inflation does decrease debt over time. And the example I've picked here is if you bought a property in 1971, the average house price was, wait for it, £5,623. That's it. There's no more zeros. It was £5,623. Interestingly, the average salary was £1,204. So that means the average property was 4.6 times the average salary. I found that quite interesting because I'm a geek. Now you roll that forward to today. So in 2021, house prices finished as an average of £268,349 was the average. Interestingly, the average wage I've already touched on is £31,258, and that is 8.6 times the average house value. So you can see they're actually, the house prices have far exceeded inflation over time. They're actually relatively more expensive than they ever were. But just to really extrapolate out the example on the debt point. So if you borrowed £4,000 in 1971, and let's just say for whatever reason you had it interest only, you still had the mortgage now. And I've picked the 40-year term specifically because if you're a first-time buyer and you push out for the maximum term available, some banks are doing a 40-year term. So this is sort of roughly why I came up with these figures. So in 1971, £4,000 represented 72% of the property value, if it was 5,600 roughly for the average property value. But if you still had that £4,000 loan today, that represents now just 1.5% of that same property's value. So that is how inflation decreases debt in real terms. And I sort of think that's what the UK government is doing, is they're doing a lot of borrowing over very long periods, and they're hoping that CPI inflation and all other forms of inflation that we experience will push that debt down until GDP goes up to a point where it's a lot more manageable and you get to pay it off. It's like a hockey stick sort of scenario they're going for there. There is a lot of talk around modern money theory, which I'm not going to get into now, but it's worth looking that up because I think a lot of that is at play. So you put that all together, we're in a sort of an environment which I can't think of, certainly in the last few hundred years. We've been in a situation with huge levels of national debt and rising inflation and rising GDP. I don't remember seeing that, but I'm not a historian or an economist. I'm very happy to be corrected. But what that means specifically now and going forward is it's going to keep interest rates very low for a very long time. I'm going to go through market rates in a moment, but just to give you an idea, 10-year swap rates, which is what banks predict money will be, is at 1.1% in 10 years' time. Now, the Bank of England base rate is only at 0.25%. So that tells me two things. Rates aren't going to go very far, they're not going to go very fast, and they are going to stay low. And that also means right now is probably the cheapest time you are ever going to borrow money at in your lifetime. Now, that is all things being equal. As we know, a lot of unforeseen things happen, but that's certainly where we think things will be over the coming years. Now, to put some numbers to this as well, so let's look at the market rates this week. Interestingly, all sort of pegged back a little bit, and I think there was a bit of a knee-jerk reaction after the Bank of England raised interest rates in December. That trend was going to continue quickly, but for the reasons I've just explored, that's probably why they're not going to go up quickly. So money market rates are down a little bit. 5-year money's at 1.142, 2-year money's at 1.075, and 3-month LIBOR is at 0.511, which indicates that the Bank of England will probably raise interest rates some point in the next 3 months. That's what money markets are hedging on. So how that translates then directly into mortgage rates, because that's the sort of money market rates, then banks obviously apply a margin above that. The best variable rate on the market right now is 0.99%. The best 2-year fixed is 1.11, and the best 5-year fixed rate is 1.46. Interesting to note that those fixed rates are more expensive than last week alone, which is why I'm banging the drum now about locking in for a long time. Might be a really good idea. Now, the interest rate you will be offered is dependent upon your personal circumstances and level of deposit. The figures I just mentioned are really based on if you've got a 40% deposit or more in a really straightforward situation. So if your situation isn't straightforward or you have less of a deposit, you may well be paying a higher interest rate than that. Okay, hopefully that's been a useful update for you, and I look forward to talking to you next week.